In this week's update, is sell in May still valid? The reward for risk for commodities keeps getting better. And the verdict on the US earnings season. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. All right, let's start with the usual market perspective. Is the US economy cooling? It would seem so on the latest data. Of course, you always need to see the trend unfolding, but certainly there is enough data to support that possibility. Unemployment was on the rise in the last numbers out, and new job openings are falling. So that's a couple of ticks in the box that the economy is cooling off a bit. And of course, that is great if your primary objective is to see interest rates cut. And so that economic data fueled the expectation about interest rates. That sent the US dollar down, commodities up, and stocks also liked it as well, and they went up. So it was a pretty good combination for the majority of last week. And coming up in this week, on Wednesday, I think it is the US CPI, which will obviously be very, very important, another very important piece of that puzzle. So, selling in May, is it a good idea or not? Well, it seems to have got a life that isn't justified because 9 of the last 10 May periods, at least for the S&P 500, have been positive. So you can hardly say that that is a very high probability event that May is going to be down on the index. Now, we may see, it may well be that during the middle parts of the year, the increase in the indices is not quite as broad. It could be narrower, left more to perhaps the larger brigade of stocks. I don't really know. I haven't done that analysis because, to me, if you get too far down that rabbit hole of looking at what history shows you, it's very easy to lose sight of the main activity. So I don't tend to get absorbed too much down there. I look for great individual stock opportunities, and I don't worry too much about historical trends. So out of the last 10 May periods, only 2019 was the only negative May period that we have. So that certainly explodes a lot of the media rhetoric out there about selling in May. So my message would be you don't want to go anywhere in the next 3 months. The show is just getting started, and the show is really only just getting started if you are focused on just the part of the market that is growing very robustly, and that applies both to America and also to Australia as well. And there are plenty of stocks that fit that bill. You don't need to be across the top 20 stocks or the top 100 stocks or across the whole market. You just need 20 or 30 stocks that are going to grow robustly for as far as the eye can see. And that's pretty easy to do in both Australia and America, to find stocks that can do that. Turning now to US earnings season, 77% beat on earnings for the S&P 500. So that's about normal. So that's a pretty routine outcome for this earnings season. It's certainly not as bad as many people were expecting. It's also the highest earnings per share growth for an earnings season since the second quarter of 2022, so almost 2 years. So it's certainly been an improvement on what we've seen of late. And if you actually want to look at what earnings are doing, then the FY24 forecast is for an 11% rise. That's for the S&P 500 stocks as a whole. Now, okay, I understand that a good part of that is being carried by a handful of major tech stocks are contributing. But there are still many stocks in the sub 50, say 50 billion market cap, which in American terms are not really all that large, really. 30, 40, 50 billion, not all that large in America. So that those can have very, very significant earnings increases without, contributing to that overall S&P figure. There have been many outstanding market responses to the growth that we've seen. Now, equally, there have been some shockers as well. So it has been a very, very diverse market. And that growth has been across many sectors. It's not just a technology-led growth situation by any stretch of the imagination. So they can be found across many areas of industrial and in other areas of the economy as well. So let's turn to American stocks now. The S&P rose 1.8% for the week. The Nasdaq a little bit less than that, up 1.2%, and it pretty much erased the April losses. So normally you would expect April to be strong and May to be weak. That was, that's the expected consensus. But it was actually the opposite way around. And now the S&P finds itself back only 0.6% off its all-time highs. So this is still a market in hefty rally mode, no question about it. Leading the way last week, though, was a bit of a different mix. Utilities did really well, up about 4.5%, and finance and materials were the next two, also in the sort of 3 to 4% up kind of bracket. The US dollar index was steady. It did fall towards the end of the week, but it ended up steady across the week. The 10-year yield has slipped back to 4.5. We're up in the 4.75s only a week or so ago. And the VIX is eased even further down to 12.5, which is certainly a market feeling pretty good about itself. Let's take a quick look now at the charts. We'll start with the S&P first of all on a weekly chart. So you can see we had 3 weeks to the downside during April, and then the final week of April, or the final 2 weeks of April, I should say, turned up, and then another positive week. So 3 in a row to the upside. This is the Nasdaq versus the S&P. So just sort of readjusting a little bit, but nothing dramatic. Yes, we've turned over. That's happened on multiple occasions. It's far too early to hang any sort of meaningful implication on that. But I'd have to say that whilst a lot of people like to think that the Nasdaq leading is the ideal situation, I think the ideal situation at the moment is a rally that's broadening. It's not just being led by the tech majors. There's the Nasdaq in absolute terms, so it's only a tickle away from its all-time highs. The important one for me is semiconductors, and Taiwan Semiconductor came out with an excellent report on a Thursday night, which was reflected in a significant gain during the Friday session, and that spiked the semiconductor sector up again. And the growth that Taiwan Semiconductors is showing is extremely strong. So things are going pretty well for that sector. And this is the semiconductors versus the S&P, so also holding up quite well. Let's look at the relative comparisons over the last fortnight in particular. XLC, communication services, was strong. Finance, technology starting to come off the boil a little bit in the last few days, but still over that period was in pretty good shape. Turning now to the Australian market, the IT sector here, which is very much a different mix to what we see in America, but the sector here is still leading the way. Energy has done a very significant catch-up. Finance also has kicked up a little bit in the last fortnight, and the rest, materials, healthcare, and small ordinaries are bringing up the rear. So that's what the individual sector flows look like. Turning to Aussie stocks, our dollar also pretty much unchanged as the US dollar was, 65.5. Our index managed to rise 2.1% across the week. and similarly led by utilities and energy here, but also real estate and IT. Small cap miners are now showing signs. It's far from universal. We're seeing increasingly, just bit by bit, small cap miners are starting to get more love from the market, and they're joining their small cap non-mining peers in a few instances is quite dramatic outperformance. There really have been some stunning gains in some of these stocks. A sustainable commodity super cycle, it's always a big statement to make, but it's now looking more and more likely for the next decade or two. Certainly copper does. Gold, you would think lithium will be back, and some of the other metals as well, tin, manganese. There are many commodities that are looking at very significant supply deficits. Precious metals, gold was up $23 on the week to $23.61, and silver finished at $28.41. Slowing US economy equals rate cuts equals higher gold price. Higher gold price for two reasons. One, because of the currency effect of a lower US dollar, and secondly, because of the interest rates. Lower interest rates are also good for gold. So a bit of a double whammy there, and you can throw in a third one. Central bank buying has just had the strongest quarter start to a year ever in recorded history. So central banks, particularly China and I understand Turkey, are still considerable and consistent buyers of gold bullion. Translated to Australian dollars, we're still looking at nearly 3,600. It's very profitable territory for Australian gold miners. Precious metal stocks, there's still no general sector-wide enthusiasm yet. So this is not a rising tide that's going to lift all the boats yet. So you've still got to be extremely selective in what you go for. So let's have a look at the precious metals market. So first of all, the US dollar, the US dollar gold price this is a weekly chart. So you can see quite a solid week. So it's really a very robust rise. The pullback from these highs was fairly sudden. There's nothing smooth and easy going about the gold price movement at the moment, but certainly a very nice rebound last week. And in Australian dollars, that's how it finished. And if we look at silver, it's silver on a daily basis also a good finish to the week. If we go to GDXJ, just to give you a bit of an idea of the global scene, you can see, yes, we've made some gains, but we're still well off the long-term highs, and we're still really within a range that the index has been in since April of 2022. So we're still within a 2-year range. And, there's nothing especially exciting about that particular chart. But look, we're getting there, slow but steady in the gold market. Turning to other commodities, copper was fractionally higher, so was nickel. And the thing about copper is, and I guess with all minerals, but particularly relevant to copper, is that this M&A cycle with, the high-profile ticket is BHP having a crack at taking over Anglo American, is that M&A does absolutely nothing to increase supply. So, supply is the problem. That's why copper is expected to be in a deficit by the end of this year, is almost certainly going to be in a very significant deficit by 2030. And M&A is going to do absolutely nothing for that. In fact, in a sense, it's going to impede it, because companies are spending money on acquisitions rather than putting money into the ground to find the next new discovery. Now, demand is expected to double by, that should read 2035. I beg your pardon, 2035 is the date. A bit of a typo there. That's according to the S&P Global Commodity Insights. So if you've got demand expecting to double by 2035 and a whole lot of mergers and acquisitions, which is not going to do much, or if anything, to increase supply, it's pretty easy to see that the deficit's just going to get bigger and has got to push the price up, because the price of copper has got to get to a level that incentivizes significant investment in new discovery. It's not rearranging the deck chairs. It's new discovery that's absolutely critical. West Texas crude, 78.2, and it's really more about demand being a little easing and geopolitical risks easing as well. Players not quite as concerned as they were about something major erupting in the Middle East. OPEC is certainly there. Look, perhaps going to be increasing supply. So crude oil has come off a bit in the last few weeks. There's the spot copper chart still working its way fairly strongly higher. And there's the crude oil chart heading in the opposite direction. Wrapping it up, just forget about this sell in May. I'm totally sick of it. If I get another article in my inbox telling me that I should think about selling in May, I think I'll throw my computer at the wall. But so forget about that. It's actually a completely unhelpful thought pattern, because it puts a subconscious thought in your mind that holds you back from making certain decisions that would hold water in their own right. So having this sell in May thing in the back of your subconscious is completely unhelpful. So try and ignore it. Try and not let it influence you in the slightest. The simple thing is to just generate a list of outstanding. I know I keep banging on about this all the time, but it's important. Repetition is important with something like this, where the vast majority of the investing population has certain predetermined myths, if you like. I'll call them myths. And it's only by repeated repetition that you stand a chance of getting ahead of the pack. So you need to generate a list of outstanding growth businesses. We're not talking 10 or 15%. I'm talking 25, 30, 40% for multiple years ahead. That's the sort of robust growth I'm talking about. And also, it's not, there are lots of companies that at various points in their journey have the potential to do really well, but they've got to have the high probability of being able to do it as well. So you need those two things together. Then just be clear on your purpose and your process. Why are you buying that stock? And the simple answer is, well, I'm wanting to make money, but that's just a bit too simplistic. You need to be very clear about the time frame and what you are seeking that stock to deliver for you, and the process that you're going to use to enter and to manage as it unfolds. So just be clear on those things. And then if all the boxes get ticked, then just buy them without hesitation and just forget about the time of the year that we're in. Portfolio analysts last week, there were multiple buy recommendations, both in Australia and in America. It was a pretty good session for anyone that's not tried portfolio analyst. There is a $1 trial for 2 weeks. That's it for this week. Short and sharp. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.